Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Leeson with Money Metals Exchange, and it is my privilege now to welcome in Dan Norcini. Dan is a professional off-the-floor commodities trader, bringing more than 20 years of experience in the markets. Dan's editorial contributions and supporting technical analysis charts cover a broad range of tradable entities, including the precious metals and foreign exchange markets, as well as the broader commodity world. He is a frequent contributor to both Reuters and Dow Jones as a market analyst and can be found as a source in the Wall Street Journal's commodities section from time to time, as well as CBS's Market Watch. You can also follow his fabulously detailed work at traderdan.com. Dan, welcome back. Thanks for joining us again.
Oh, Mike, it's great to be back. It's been a while, my friend.
Well, when we first spoke earlier this year, it was right after the big news came out in Switzerland where they decided to unpeg the franc from the euro, which sent major shockwaves through the currency markets. And now this week we've seen some pretty interesting action in the markets, so our conversation is well-timed once again. As we're talking here on Thursday evening, we've seen a big advance in the metals so far this week and a pretty big move in the dollar, although they're going in different directions here. So summarize what you've seen this week, and then also give us an idea of what has driven the moves here.
Well, Mike, you could probably sum it up in one word, is pandemonium. That's the word that comes to my mind, and particularly, when you're looking at the bond markets, and not just the U.S. Treasury market, but the global bond market, to me, has been the instigator behind a lot of these disruptions that we've seen and taking place now, really, I guess, since the beginning of May, it seems like. And in particular, you're seeing a lot of, turmoil, cross currents that are impacting other markets as huge sums of money are just simply being moved. Traders are repositioning. Some of them are lifting trades. Some of them are putting different, new trades on. But there's a lot of money changing hands. A lot of these trades were crowded trades. A lot of guys piling in on the same trade, essentially at the same time, and using the same sort of philosophy or sort of sentiment that was directing those trades, and now all of a sudden we've got an unwind going on, and everybody's headed to the exit at the same time. And quite frankly, there's no liquidity on the opposite side of some of these markets, Mike. And so you're getting big pushes, particularly in the bond markets. And as you mentioned, you're seeing certainly you're seeing some movement in the currency markets, especially with the dollar. I mean, the dollar is quite frankly has surprised me to the extent of the downdraft we've seen in there recently. It was not something that I had expected, but it sure has seemed to have taken place ever since the sentiment has shifted with that first Fed rate hike being delayed. Boy, that thing really changed things in the currency market.
As we've discussed before, it is all about the Fed these days, and rate hikes seem to have been priced into the market. They were talked about for a long time. So if it becomes clear, and I guess it is, that won't be happening, that we won't be getting those rate hikes, what effect will it continue to have on these markets? What will the market reaction be, not just with the dollar, but commodities and metals as well?
Yeah, let's start with the currency markets first, Mike, and then we can go to the interest rate markets and down to the precious metals because they're all, related in that order as well. But with the currency markets, obviously, the dollar had been moving higher heading into really the end of last year or early part of this year in anticipation that, the Fed was going to make its move here on interest rates before anybody else in the major Western industrialized nations were. I mean, we were the only ones even talking about the possibility of higher rates. The rest of them were either talking about maintaining the status quo with, the quantitative easing and monetary stimulus, like Japan, for example. And then at that time, before February, we were all talking about what the ECB was going to do for its QE program. Well, that sort of thinking essentially said, okay, the dollar is the only game in town if you want to talk about yield. And so money was just coming into the dollar. It was, pushing treasury prices. It was pushing the currencies. And, of course, it was also having the corresponding effect a lot on commodities as well, mainly because of the fact that stronger dollar, it initiates a trade, and I call it a macro trade. It's essentially big funds that usually follow the dollar, and if the dollar goes up, they sell commodities. If the dollar goes down, they buy commodities, Mike. There's really no questions asked. There's not a lot of thinking. There's not a lot of fundamental analysis that goes into that trade. It's sort of a knee-jerk, reflexive type of trade, but so many big funds practice it, and there's so much money involved in it that it just really tends to influence these markets. So as long as that dollar was trending higher, had general pressure across the commodity world, and essentially you could see that reflected in the precious metals as well. Well, it started to change really when we got that stinker of a jobs report. It was the March jobs report. You remember that? I mean, it just shocked everybody how poor it was. And, of course, that to me seemed to be the catalyst. From when we got that March jobs number, and I forget what it was originally, like 127 or 128,000 created when the market was looking for over 200 something initially. Well, you saw big dislocations in the market at that point. People really began to reevaluate what they were going to do with this dollar trade, simply because it sure did seem like the Fed was going to be on hold for any rate hike. And you certainly saw that reflected immediately in the Fed funds futures market. I mean, the probability of Fed rate hikes in June just just fell through the floor. People all of a sudden said, wait a minute, they're not going to move in June. I mean, we'll be lucky if they get a move in September, and then maybe we're going to have to wait till December. Well, that began to catalyze what was going on in these currency markets, and as a result, you began to see a lot of movement out of the dollar. And also, which was interesting as well, was that the weird thing about this was that people were talking about interest rate hikes in the dollar, but that made money come to the U.S. bond market. I mean, think about it this way, Mike. If you're looking at a 10-year Treasury note, it was paying around 2%, versus the yield on the 10-year German bond, which was about 0.2%. So, I mean, there was no comparison. That was a no-brainer. So you had all sorts of money flowing from all over the globe into U.S. Treasuries, actually working to push rates on the long end of the yield curve lower, even though we were talking at that time about the Fed hiking rates. So you had this sort of conundrum taking place where the more the Fed talked about raising rates, the lower they got. So go figure that one out. Well, what happened was, once the thinking shifted and people began to postpone this rate hike, again, starting with the economic data from that March payrolls report and then subsequently being reinforced by the reports that came out afterwards, whether it was the PMI numbers or whether it was the various reports, whether it was retail sales, consumer durables, or whatever, the numbers were consistently poor. And so, again, you had a shift. So then money began to come out of the bond market, the U.S. Treasury bond market. You had a big sell-off start there. The dollar got pressed lower. And, of course, now all this money is coming out. And particularly, you're looking at the so-called safe haven place. People are saying, okay, bonds are the safe place to be. Look, we've got from the European standpoint, we got the ECB backstopping us. We know we have a buyer for bonds, so we can go into bonds. Here in the U.S., all that money's coming into bonds there. Okay, it's a safe place to be. Well, that now is thrown in doubt, and so you see this huge exodus of money coming out of the bond markets. And again, now we're having this same perverse effect. The longer the Fed talks about not raising rates, here we go again. Now the rates are going higher. So it seems like when the Fed talks about raising rates, they go lower. When the Fed talks about not raising rates, they go higher. And all this is the result of money flows, Mike. It's simply money moving in and out of these bonds, trying to anticipate what these central bankers are going to do next. Well, if you think about it this way, what was the ultimate safe haven as far as traders were concerned 2-3 months ago, or even a month ago? It was government bonds, whether it was Euro bonds, whether it was Treasury bonds, whether it was Japanese government bonds, whatever. Now, government bonds are not looking so safe because of the turmoil, so now they're turning to gold. And you're actually seeing a safe haven flow into gold as a result of this, and that's why gold popped up off of its support level down there around 1180 when all this turmoil in the bond market began. Because typically, Mike, what we've been seeing is as interest rates began to rise in the U.S., at least on the long end of the curve, that was actually bringing selling pressure into gold. Gold was moving essentially inversely to the interest rates. If interest rates on the long end were going up, gold was going down simply because it's a non-interest paying asset. And traders felt like they should buy, investors are looking for a safe haven. They say, hey, I want to get some return on a capital. I want to get something that's relatively safe. I don't want any capital gains risk. I'm just going to put it in bonds. So as interest rates would go ahead and essentially move one way, gold would move the other. Now, as a result of this bond turmoil, we're seeing bonds selling off, which is pushing interest rates higher, but gold is moving higher along with the interest rates. So now we have a different pattern where gold is moving lockstep with interest rates as they move higher, and it's a direct result of this bond route and the turmoil in the bond markets, and traders and investors looking right now for an alternative safe haven besides government bonds.
I know when we spoke earlier this year, that was one thing that you were looking for to get us out of this sort of consolidation or corrective period in the metals, gold specifically, is that it needed to start acting as the safe haven again instead of government bonds. So we've started to see that shift perhaps occurring, and maybe the tide has turned for gold?
Well, to me, it's a little too soon to say that with absolute certainty, Mike, but there's certainly signs of it taking place. I mean, the problem that we have in trying to read these markets, and I think anybody who's been around these markets long enough, particularly with the volatility and the rapid shifts that we see in prices, even on an intraday basis. I've joked and quipped among some trader friends of mine that we're now seeing a 6-month business cycle completed in 24-hour trading session. And essentially because of the volatility, I mean, you just see these huge swings in price, but certainly, I mean, you're definitely seeing gold functioning as a safe haven here at the moment, simply because that money that's coming out of bonds has got to go somewhere. Normally you would see it come out of bonds, it would go into equities. If it was going out of equities, it would go into bonds. Well, there's so much uncertainty and confusion out there, and all of it, in my mind, is being introduced by these central bankers. What are they going to do? When are they going to do it? What's next? Whatever, that a lot of traders are simply getting nervous, and they're dumping various asset classes that they had been previously heavily positioned in, like bonds, for instance, and they're saying, all right, where are we going to put this money? And so a lot of them are putting it into gold right now, and they've managed to push it up. I mean, that's the thing. They pushed it away from support. It looked like it was going to break down, but they've shoved it back up toward resistance around 1220. It's holding up here. It hasn't broken out to the upside. I personally, Mike, if the rout in the bond market, as sharp as it's been and as severe as it's been, I thought that we might see enough safe haven flows into gold to push it through this heavy resistance level around 1225. I thought we might make it up to about start at 1250 and maybe even make it as high as 1300, given all the turmoil that we've seen out there. But we haven't seen it yet. And I think part of that is there's a lot of people who simply don't believe the bond market is going to, could possibly break down any more severely, simply because the overall economic global growth numbers we're seeing are so slow. Let me give you an example of this. Yesterday we got the retail sales number, and there was no doubt that was a very poor number for here in the U.S. I mean, it's very disappointing. Remember, we were anticipating a pickup in retail sales because we were able to blame the poor showing in the month of March on the bad weather, the rough winter weather. Winter wouldn't go away, so we thought, okay, that's a one-off. It's an anomaly. The consumer is going to take advantage of maybe these lower gasoline prices. They're going to spend more money now for April. Okay, so we get the April data yesterday, and what is it? It's a stinker. They didn't spend more money. So people got shocked when they saw that number. Okay, now normally when you get a poor number like that and you get a very slow growth confirming number like that, what happens? Well, money just pours into the bond market. Well, that's exactly what happened in the first hour of trading. The bonds took off. They moved to the upside, like what you would expect them to do. And then what happened? Right after that, it seemed like everybody who was looking for a place to sell bonds decided, hey, the market's up about a point, let me just slam it. And all of a sudden, the bond market started seeing selling, and they just shoved it lower, and they crushed it again. So, there's this whole thing is that, the bonds are not functioning like they typically do in times past. That's made traders and investors nervous to a certain extent. And so you have seen some money come into gold as a result of that. That's where some of that safe haven flow is coming from at the moment.
Turning a little bit to silver and some of the technicals there, what are you seeing on the white metal and then also some of the other industrial commodities? I know we talked a little bit off air, copper, platinum, palladium. There's some things to notice on those metals as well.
Yeah, silver, I'll be honest, silver has really surprised me, as has copper, Mike, as has palladium, and as has platinum, all the ones that you mentioned. For the reason that we discussed here, too, is that, look, all these markets, I mean, all these commodities in general are all moving lower as we were, coming out of the first of the year. We were looking into, January, they had a little bit of a peak there as far as the metals go. But, I mean, crude oil, my goodness, we watched crude oil drop from, $80 a barrel all the way down to $44 in mid-March. We saw silver prices fall down below $15, actually spiked down very close to $14. Copper prices had dropped off very hard. Platinum was going down. So all of these commodities, which were, let's just call them growth-dependent or growth-sensitive commodities, were all moving lower, mainly because of fears of slowing global growth. I mean, I don't think that's a secret. Anybody who's been following these markets is pretty much aware of the fact that, look, global growth is not very good right now. And so these demand-based these commodities, that are so sensitive to demand, were all moving lower simply because there wasn't enough growth to pull prices up and eat through the available supply. Well, lo and behold, we still have the same slow growth concerns. As a matter of fact, that's the reason we're all talking about the Fed postponing rate hikes now. I mean, because, wow, look, the economy's so slow, there's no way the Fed can hike rates. They may not even hike them in September. We may have to wait till December. That's the general thinking. But yet, in spite of that slow growth, we're watching silver moving up. We're watching copper moving up. Platinum's going up. Palladium's going up. Of course, gold's moving higher. And we're watching crude oil. Crude oil jumped from $44 a barrel to hit $62. So my question is like, how can we have these various commodities that are so growth sensitive? How can we have all of these commodities moving lockstep in higher at the same time we're worried about slowing global growth? Well, answer that question and go to the head of the class. So, I mean, it just shows that there's some strange things going on behind the scenes, a lot of money being moved, a lot of repositioning taking place. Some of this is, again, it's hard to say whether this is simply too many traders on the same side of the market reversing positions, and you're seeing take a while for that repositioning to wind down or subside simply because of enormous sums of money involved in it. Or is there a subtle change that's taking place in sentiment that we haven't quite picked up yet, and maybe there's some winds blowing and saying, hey, there's a possibility that sentiment could be shifting about this overall slowing global growth, the deflationary scenario. Maybe, just maybe, and I posited this on a website yesterday, maybe we're seeing some very early signs of stagflation out there where you have, rising prices in the midst of slow growth. That's essentially how I define stagflation. Maybe we're seeing some incipient signs of that, Mike. I don't know, but certainly it would help explain a little bit of some of the reasons we're seeing some of these prices move higher on these economically sensitive metals like copper and platinum, for example, and to a certain extent silver because of its quasi-industrial role. It's a monetary metal and an industrial metal, and it tends to kind of follow along with copper at times. Sometimes it tends to follow gold. Well, right now, both copper and gold are going up, so silver's got everything going with it because industrial metals are going up and so are precious metals. So, that's why it's rising, although it's really surprising me, to be honest. Like I said, so did the rise in copper, for that matter. I did not expect to see copper prices rise in this kind of environment.
Well, if you look at the stagflation back in the 1970s, that was an environment that was very good for precious metals. So if we do get that, we could see some real follow-through here, I suppose. Before we wrap things up, give us an idea of what the charts look like for gold and silver. What are you looking for there? Support levels, resistance levels, et cetera.
Okay, well, let's start with silver first, Mike, because it's had the stronger move out of that and gold, let's say. I mean, we've had, I thought when I looked at silver, I mean, you can look at a chart as sort of in a steady downtrend. It looks like it's found value-based buying down around the $15 level, though. I mean, it meandered down there for a while. It would hit that level. It would bounce up a little bit. It would hit that level again. I mean, it went down there in November. It went down there in January. It was down there in March. It was down close to that level again in April. And every time it got down there, it didn't really continue to break lower. It stabilized down there. And now what that tells us from looking at the chart is simply that there are value-based buyers that work in the silver market below the 1550 level. Those guys have been there for months now. It's going all the way back to November. So what do you got that? 6 months? So for 6 months, the same buyers that see value in the metal down there have made their presence felt. So they've essentially put a bottom in that market down around there. What we've lacked in silver on the upside is that momentum-based crowd, Mike. That's the hedge fund crowd, the large specs that come in, and they're not necessarily value-based buyers. Matter of fact, I don't think the word value even has a place in their lexicon, their vocabulary. All they know is if it goes up, we buy it. If it goes down, we try to sell it. So, but they're the guys that you need to come in, and you want to see a market move higher. You need that crowd to get involved because that's the ones that just chase prices. And if it goes up, they'll chase it. Well, looks to me like we've pushed out the move yesterday in silver and to a certain extent today. Looks to me like we pushed out a pretty significant amount of shorts in the silver market. You had a heavy accumulation of shorts in that market. They were not net short yet, but they've been building some new short positions. Looks to me like they got pushed out. That's one of the reasons you could tell it's a short covering, because a market that rises that fast, that quick, that abruptly, that vertically, there's always trouble for one group of traders, and that's the shorts when that happens. So you pushed them up now to a key resistance level around 17.5 on the silver chart. You had some sellers come in there in February. You had them show up again in March to a certain extent. So the question is, okay, are the same silver sellers that were active in February and March, are they going to show up now? And do they think silver prices are expensive here at $17.50? If they do, they'll make their presence felt and they'll push the price away from that $17.50 level. So far, they haven't done it. I mean, today it looks like the bulls were able to take it through that level. They're holding right around there. So to me, Mike, watching this, particularly tomorrow, because it's the end of the week, Friday, the weekly close has a lot to do as far as traders' psychology when they go into the following week to trade. You get a strong close in the market for the week, you generally see some carryover momentum-based buying the following week, at least in the early part of the week. So to me, the big test for silver tomorrow will be, can this metal close up above $17.50, or at least can it close closer to $17.25 or higher? If it does, it's got some upside momentum, and you might see some more shorts come in there and actually cover again next week. If not, I can see where you'll get some pressure on this market and it could drop back down. But that's the key that we have to watch now. If this market retreats, where will the buyers show up, Mike? And that what we're looking for now, we know they've seen value at $15.50. They've even seen value now slightly since the beginning of May, closer to the $16 level. The question is, if silver does set back, where will these value-based buyers arise? And trust me, we'll know it by their footprints that they leave in the market. You know, you can't hide whether you're buying or selling in size. It always shows up on the chart. So if they come in and they're starting to buy above 16, let's call it above 16, maybe 16.25, you can make the case that this market is building a pretty good base down here. And if it gets a spark, and again, I don't know what the spark might be, but if it gets a spark, you could see it go ahead and pop up and maybe even make a run at 18. But again, before we can even talk about $18, we got to clear 17.5. So that's our overhead resistance level. As far as the chart support, like I just mentioned, somewhere around 16.25 is what I'd like to see this thing hold on the downside if it goes down there. For gold, we have gold pretty much trading in a band, Mike, a range trade. Matter of fact, it's been so boring from a trading perspective because this thing has been going on now for about 6 weeks. It trades up to about 12.20 to 12.25. It immediately encounters selling up there. It drops down to about 11.75, 11.80, and it immediately encounters buying. So it's been stuck in a range, roughly a $50 range, it's called, from 11.75 to 12.25. And it's been in that range for 6 weeks, just going nowhere but moving back and forth, up and down, without a lot of rhyme, without a lot of reason. And so it's been frustrating for a lot of traders, both bulls and bears, because every time it gets to the top of that range, they go, okay, it's going to finally break out and trend higher, and then it disappoints, it falls flat on its face, and it goes down. Well, when the bears start getting excited, yeah, it's finally going to break down, and we're going to go through 11.75, we're going to trend lower, well, it flips right around, goes right back up again. So neither bull or bears have had advantage in this market for 6 long weeks. Well, here we are today on Thursday, and what did we do today? We pushed right up to 12.25. Matter of fact, we closed at 12.25 in the pit session, right near the top of that previous trading range. So here's the key question. Do we push through this tomorrow on Friday, and do we finally break out of this thing to the upside, or do we fall right back down again, and do we retreat down toward the bottom of the range? Well, I don't know. I mean, we'll have to wait and see what we get tomorrow. But right now, Mike, those are the parameters that we're watching for gold. And unless we can get a convincing close above 12.25, I don't see any upside in this, because what will happen is the sellers will come in there and they'll say, okay, there's our level to sell against, and they'll push it back down. But unless we can close below 11.75, the bears can't press it lower either. So personally, I'd like to see this thing break out of the range one way or the other. I know most of your audiences probably want to see it break up to the upside. But either way, let's do something, gold. Let's either get something going to the upside or break down or whatever. But, until we can get out of this range, that's what we're at. We're in a sideways trading pattern, and one way or the other, this market is going to tip its hand what it wants to do. So, again, will it garner additional safe haven buying if the bottom market route continues? That, to me, is the key question. If bonds keep selling off, I could see where more money will come into the gold market for safe haven as an alternative. And you could see it break through the top side of this range, and then we can maybe get some sort of possibility of a trend, or at least a push higher to another plateau and get it out of this trading range. Maybe we could move to a trading range where we got 12.75 maybe on the top and 12.25 on the bottom, sort of stair-step our way up. But right now, that's the current scenario. Range trade until this market does something else, Mike, and proves itself.
Well, it's always a highly educational experience to talk to you, Dan, and we definitely appreciate it and your wonderful insights. It's always great to talk to you, and thanks for taking the time, and hope you have a restful weekend, my friend.
Well, Mike, thanks again. It's a pleasure to be with you on your show here. Appreciate the service you provide for your audience out there. Some all these interesting articles and interviews that you do. So thanks for having me, Mike. I appreciate that.
Well, that will do it for this week. Thanks again to Dan Norcini. If you want to follow the fabulous market commentary and technical information that Dan puts out, just go to traderdan.com. Check back next Friday for next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.